Hi, everyone. This is Tim McCusker, Chief Investment Officer for NEPC. Thanks for joining us today for our 8th annual Investment Manager webinar. Our original invite, we transposed the 8 and had it on April 8th, so we were testing your commitment to see if you'd actually call in during Sunday afternoon at the Masters. But really, it's only the Thursday afternoon of the Masters and Boston Red Sox opening day here that we're having this. So thanks to all of you who have committed to this. We'll try to give you some good information and get through it quickly. Our goal is to work constructively with all of you, the asset managers in the investment management community, and to identify managers that we think can help meet and exceed our client objectives. And that the hope there is that we can deliver solutions to our clients that help them exceed their long-term returns. And that we can partner with investment managers to do that. I think it can sometimes be an adversarial relationship. We want it to be more of a partnership where we're working together to help solve client problems. I should mention that in your WebEx panel, at the bottom of your panel, there's a place where you can ask questions, so feel free to write in. We will leave some time for questions at the end. I'm joined today by Dulari Pancholi, Principal and Senior Consultant on our hedge fund research team, and Tim O'Connell, a consultant on our traditional research team. Some of you may have worked with Tim in the past. He's spent a long time covering equity long short for us. At the end of last year, we moved Tim over to the traditional research team to continue to focus on equities, but to try to leverage some of his skills in the equity long short space. And how we do our equity research. So some of you in the equity space may be getting to know Tim now. In terms of an agenda, I'll give a quick NEPC update and market and client outlook. I'll also touch on our search activities, some stats that I know are important to all of you. Tim is going to take you through our NEPC research coverage, who covers what for us, and the process that we follow for traditional and hedge funds. And then Dulari is going to walk through a new rating system and a focus on fees, which we've been talking about with many of you, and which clients are demanding that we take a really close look at our investment management fees, but also our own fees. So we're feeling that pressure from both sides. And then some final thoughts and questions. So NEPC, we are now almost 280 employees, 8 offices, continue to be 100% employee owned. Continue to derive all of our revenue from advisory and discretionary consulting. You can see on the right-hand side, the very balanced mix of client types. I hope you all have a perspective on the consulting industry that we don't necessarily get. But from a competitive standpoint, I hope that we are the most diversified of all the consultants out there. We have strong, stable and well-branded practices in each of those businesses, and we're really proud of that. 358 clients, and that $954 billion as of 9/30, I think has eclipsed $1 trillion now, so we're pretty proud of that as well. I should touch on discretionary consulting for a second. That's been an important growth area for us over the last few years. It continues to be a focus for us. We don't show it as a separate practice because it's an offering that we make to all of our client types. I would say the focus areas have been more in corporate and endowment and foundation, healthcare maybe as well, a little bit in Taft-Hartley, not much in public or in private clients. Private clients have been an area of focus for us as well. Our focus, if we could sum it up, is to feel small but be big. We want to have within each of those client types, we want to have a boutique feel. We want to bring expertise in each of those practice areas. We want to be nimble and identify niche managers and investment ideas and deliver expertise in each of those areas. But we want to do it with scale. We want to have the deep resources of a 50-person research team. We want to use that size to get the best possible commercial arrangement we can for our clients in terms of fees. And then we want to take that opportunity to work across clients to leverage ideas to the extent there's an interesting idea in the endowment and foundation space that might be applicable to the public fund world or the corporate world. We want to take advantage of that. ESG and impact investing would be a great example of that, where over the last several years, I think Dulari is one of our co-chairs of our impact committee. I think we've been leaders in that space, and that really started in the endowment and foundation world, but that conversation is happening more and more across all of our client types, and we think we have an advantage from having experience in that space already. Our market outlook, and the reason that we go through this with you, I'm sure you all have professionals at your own firms who can tell you their views. The reason we go through this is that our views lead directly to the search activity that will take place in our client base over the course of the next year and several years. So we think it's an important context to give to you when you see our search activity over the last year and what you might expect going forward. First, just a comment on key challenges facing investors, so you know the things that they're thinking about. This is from Greenwich Associates. It's an important study that we look at so we can understand what clients are thinking and feeling, what they think about us, and what they think about our competitors. I'm sure many of you do the same. You can see after a year of really strong returns, rate of return and funding issues are a little less acute for clients, but asset allocation with valuations where they are across markets has jumped back up in importance. And then importantly for all of you, manager selection continues to be an important area of focus and an increasing area of focus as clients look to get as much as they can from active managers, or candidly considering passive where appropriate. I think a challenge for us is working across those different client types. You can see the diversity of approaches across these client types. So it's a real challenge, candidly, for all of us in research, because we've got to be able to bring ideas to all of these different clients and meet their needs across very different asset allocation, risk profiles, and interests of manager types. You can imagine some of these are looking for very risk-controlled managers, maybe index-based managers, or target tracking error managers. You might think of a corporate plan on an LDI path, not looking to take undue active risk, and compare that on the other end of the spectrum to an endowment looking for a lot of active share, looking for a lot of active risk in their portfolio, a lot of concentration and high tracking error from their managers. And so we're trying to meet all of those needs on the research team and provide a diversified set of options for our clients to consider. Shifting to the market outlook, just quickly, we think outside of the U.S., things are more attractive in the equity space. This is what we rolled out to clients at the beginning of the year, and so we said market stability cannot elicit complacency. I think you've seen the benefits of not being complacent this year to the extent that investors rebalanced at the end of last year and captured some gains. They've benefited from that. And we've seen a little bit more volatility this year, driven by some of the headlines out there. We think that credit markets and U.S. equities look a little bit stretched. We're balancing that with the idea that there's some good economic activity going on right now, and we do think that this can run a bit further. This just shows you the Sharpe ratios and compares how far things have run. You can see how strong markets have been, particularly for U.S. equities, but high yield as well, and shows you there might be some opportunities in other asset classes. And then bringing it to our key themes and current opportunities, I mentioned we think economic activity is pretty good right now. We don't think that an economic cycle just dies of old age. So we think that the U.S. economic cycle can run a bit further. We don't think that it can run indefinitely. It's our third longest, but it's one of the weakest that we've seen. So we haven't really seen excesses build up to snap a strong recovery and bring us into recession. The big difference relative to last year, we were talking about the U.S. economic cycle continuing to run last year. The difference is that other global economies have come along. We've seen Europe and Japan have pretty good activity. Emerging markets seem to have found their footing as well. They're all supported by the Federal Reserve and global central banks continuing to take a very gradual, deliberate approach to any tightening and any unwinding of stimulation that we've seen. So we think that that continues to be supportive for markets. Even as we've seen a rate hike this year and the market start to extrapolate future rate hikes on the margin, We think while that's nipping at gradualism, the Fed's stance continues to be very gradual. They want to be very careful about any tightening that they undertake. We've seen China be very effective in their transition, a social transition, an economic transition, a monetary transition. They've been slow and deliberate in that. Recent news about an abolishing of term limits. We don't think disrupts the transition. We think that they are what it does is really extend what has been going on there for a long time, which is a consolidation of leadership. And then the theme that we had in place a year ago that worked out very favorably last year is globalization backlash. There were concerns about elections early last year. Those played out more towards convention, and that was good for markets. We've seen it play out more this year in trade activity and concerns about tariffs and a trade war, and that's brought on some volatility to markets, and that's certainly an area that we're looking at closely. We just posted a blog on that, and we are posting a lot of our ideas as current as we can on our website, so feel free to take a look at that. So those key themes, which we think cut across many different markets, lead us to current opportunities, and this is where you will see not only portfolio activity but potentially search activity. So as I mentioned, we think U.S. equities have run pretty far. I think you should be trimming U.S. equity gains, overweighting non-U.S. developed market and emerging market equities, allocating to tips from core bonds. You don't see inflation in any of those key market themes, but we do think that it's a risk. We don't think that tips on an absolute basis are so attractive with a 2.5 or 3% expected return, but we think they're more attractive than core bonds, and diversifying clients' bond exposure we think makes sense. Reducing return-seeking credit exposure like high yield and external emerging market debt is an action that many clients are taking. We do like local emerging market debt still, and then we like diversifying asset classes like macro hedge funds and long volatility exposure. Very focused there on strategies that can deliver a positive carry. There aren't many of those, so we're not looking to just write insurance or buy insurance rather on portfolios. We're looking for particular strategies that can give us some exposure to long volatility without a lot of cost. And so if we look back on the last year, you can see some of the search activity that we've had. We had 650 plus searches last year with almost $36 billion in assets being placed. That number, the 650, is actually down relative to a year ago. We were over 700 last year, but a smaller number of 30 billion in assets placed last year. That number, the asset number, can move around quite a bit if we have some large clients doing searches. That can swing that number quite a bit. But you can see many of those themes were in place a year ago. You can see the high numbers in international, global, and emerging at 133. You can see not a lot of activity in the U.S. asset classes. Not much in high yield, where we're looking to trim and redeem there, not looking to add very much. A decent amount in global bonds / emerging market debt. Those searches are basically entirely emerging market debt. I don't think we've done a global bond search in several years, although that may be capturing multi-sector and unconstrained bond strategies. And then down at the bottom, you see a lot of searches in private equity. That's just the nature of the private equity asset class, where we've got to be adding new commitments every single year. And then page 15 just gives you some historical perspective. You can see several years of searches stable after a big uptick in 2014. The other place where we'll see some noise here is not just large clients doing searches, but manager events. If we have a large manager with assets across many of our clients, and there's some sort of ownership or personnel disruption, that can lead to a lot of search activity. We didn't really have that last year. Maybe in a few small places, but not enough to disrupt the numbers. I should also mention that we will, as always, we're recording this webinar, and we will post it on our website afterwards. So if you want to dive deeper into these numbers, you can do that on our website. So with that, I will turn it to Tim O'Connell to take us through our research coverage and process.
Perfect. All right. Thank you, Tim. So today we're going to talk a little bit about our organizational charts across the research team, focused mostly on traditional and hedge funds. Second part will be to talk through kind of the research process on those two teams, utilizing screening and kind of bottom-up selection. And then Delaria will talk about one of our areas of focus kind of at the end of my section. So won't spend too much time on this, but I'll leave it up for a couple minutes. This is the entire research group of about 50 individuals, asset allocation, traditional research, as well as private markets and hedge funds. I think what's more important is what do we cover? And so starting with traditional here, I'll start up on the top left. We've circulated this chart over a number of years. I think there's one thing we added this year. So starting with the gray box on the bottom, I know a number of you interact with the senior members at the consultant or analyst level. What I wanted to do is provide additional information. As you know, we have research associates that back up and support a number of our consultants. So when you are reaching out to a consultant listed in green for an area, please do copy the associates below, particularly as events happen at firms. It just allows for a redundancy and backup in case someone is on the road. So talking a little bit about changing coverage. So we start on the left. Kirsten Christensen joined about 9 months ago, and she has taken over kind of U.S. all-cap flex equity and global equity. And so she's taking over areas that Jeff Markarian and Donna covered. And so what we've chosen to do in international and emerging markets is split those amongst members of our team, and we'll get to that in a second. Steve Gargano has inherited most of the U.S. small, mid-cap, and SMID-cap categories. And so he's backed up by Ashley Considine and Seth Goldman as well. And then moving to the non-U.S. side, you'll see John Lutz, who spent a lot of time here with Jeff, is now covering kind of international equities, and I'll be helping him as we kind of build out that list over the next 12 to 18 months. Phil Nelson is continuing to do GAA and risk parity. Aidan Redmond is continuing to be our TIPS, REITs, and MLPs coverage person. I think there's one distinction here is we do list alt beta. We've actually shifted alt beta to our hedge fund side and actually segmented smart beta and alt beta to two different segments, and we'll get to that in a second. In emerging markets, so many people know Haley Tran from the debt side. She's often covered kind of emerging market and global debt. We chose to move emerging market equities to Haley, and so she will be kind of an emerging market expert for us going forward, and Kevin Donnelly is the best person to copy there, kind of in your interactions with her. Limited changes with Taylor. Taylor continues to work with Haley across fixed income, as you can see here, high yield, munis, and most of the core bond strategies. Roseanne has taken over index. She's been doing this for a couple of years. One area that we've added to her coverage would be the smart beta area. So as that landscape evolves and starts to look a lot like some of the index providers, Roseanne will be picking that up, and that's a newer transition. So she would be your person for smart beta. And then on the bottom, as Tim mentioned earlier, my role has shifted. I moved to the traditional team at the end of last year. My goal for now is to kind of serve between the cracks. So I kind of think of it as an opportunistic equity today. Strategies that don't quite fit in a neat box come to me. And over time, as we look at doing more regional, country, or sector-related strategies, I'll be taking the lead on that. But in the meantime, working somewhat as a floater across some of our flex equity areas as we try to combine some of the strategies we know well on the long-short side with areas and opportunities on the long-only side. Moving to the hedge fund team. So up on the top left, you can still see me here for the time being under equity long short. We do have a new employee coming to take over my space. And so once they join in a couple of weeks, we'll be able to update this chart. In the interim, I am still kind of the main point person for equity long short with Alyssa Howard. Credit, Amanda Carlson, some of you may know, has spent a lot of our time in structured credit. She's going to be taking a broader role here across corporate and structured credit in the hedge fund landscape. Delaria, who's on the call here, covers event-driven strategies ranging from distressed debt to multi-event to activists. Seth and Alyssa, as some of you may know, do global macro. But if we go to the bottom here on multi-asset, I did mention on the previous slide kind of the shift of alternative beta. I think from a landscape and a market standpoint, we've seen a blurring of the lines between certain GAA, multi-asset strategies, hedge fund, multi-strats, fund of funds, and alt beta. And so we've consolidated that down to Reno Eklord, who's running point with Larissa Davey, kind of across that suite with Neil Sheth helping. So let's talk a little bit about our research process. We spend a lot of time looking for, under the key manager criteria, kind of consistency. So we've laid out 3 questions. Have you done it before? Consistent alpha across risk levels, and is it part of your core competency? Why do we think you can keep doing it going forward? So the idea is we develop our investment thesis, and then we're constantly checking that investment thesis as to why we think you can persist with that alpha. And then really the solid and stable organization structure. Coming from the alternative side, I can see a number of cases where this last one, which may seem third on this list, is almost the most important. We want investment professionals to have a stable organization so they can do their craft. And so oftentimes this becomes one of the most important areas that we focus on. So starting with the traditional side, we spend a lot of our time on universe screening. And so the point I would make here is eVestment is where we get most of our data. We also supplement that with Morningstar. So I would make sure that your information is up to date in eVestment, and particularly for strategies that you're either incubating or have just started and might not even have a 3-year track record. We would suggest continuing to put that into eVestment so that we're at least aware of it as we go through our screening process. We do have a quantitative scoring on the traditional and alternative side, so I'm going to skip just quickly. We call it our past analytics. And so what we're trying to do here is answer some of those questions with backward-looking data, which is, how do we think your consistent alpha can be generated? Why do we think it's consistent? And so we have a number of statistical tools here that we have developed, some common, some more internally developed, that we use to help score managers. And we also look at that kind of on a length of time. So how long you've done it and how persistent it is. And I don't need to get too into depth in this. I do that sometimes and people's eyes gloss over. All right, so I talked, before we go over to Dilawri and the fees, the process I mentioned is a little bit traditional skewed. On the hedge fund side, we do spend a lot more time trying to develop those universes to understand who is similar and who is not, and then feeding it through a somewhat similar but slightly different process, because the goals we're trying to solve can be slightly different across hedge funds and traditional. So with that, I'll turn it to Dilawri to talk about fees.
Thank you, Tim. So just to quickly catch up on fees, this has been an increasingly big area of focus for a lot of our clients and us as well, and you probably face it directly at your end as well. So without belaboring it, this is an area that we are going to spend time going forward. We have actually created a fee committee internally as well that looks at different combinations of fee models that might work for different strategies and different client types. Some of the main areas where we've seen, kind of fee structures work out for us as well as for managers is, either reduce the performance fee or the management fee. We also do various tier structures where there are different combinations of performance and management fees depending on how much aggregate assets NEPC'S clients add up to. We've also done some cases where we've introduced hurdles or a pref rate before the performance fee kicks in. So this is something that we are very actively working on. There is a lot of pressure in the industry. You face it directly, so I won't belabor the topic. But we have over 80 managers on our preferred list now that offer fee discounts to our clients. So in terms of how does that fee discount break out? This chart just quickly tells you in terms of numbers how many funds do we have across different segments. So the most number is in traditional, followed by hedge funds, and then direct lending, where we've created custom structures with terms for our clients. While traditional is at the highest, I would kind of be quick here to point out that in terms of the average basis points, some of the savings have come more from the hedge funds as well, given that the fee structure is higher there as well. So on average, the traditional funds that we work with we've got fee discounts ranging from 20 bps to 25 bps in certain cases. On the hedge fund side, it breaks out between management fees and performance fees. with management ranging from on average 40 basis, 25 to 40 basis, with performance fee anywhere up to 20 basis on top. And that's on the aggregate asset, not just on the performance. On direct lending, we've had a lot of success in terms of negotiating and creating, creative solutions for our clients. So we've had better fee discounts there as well. And lastly, but not the least, private markets is also an area where we've kind of increasingly seen more fee discounts being offered.
And Dulari, I'll just jump in with another quick point. The fee discounts that we show here are available for all NEPC clients. An important note, we've mentioned our discretionary business at the beginning. I would say the majority of managers that we're using in discretionary are offering some sort of discount to our clients along those same terms that Dulari talked about. And in that case, managers are looking at that saying, NEPC is my single touch point there. I don't have to interact with the clients in the same way, so there are some real cost savings that we can pass on to the clients.
Okay, thanks, Tim. And also in terms of locking up liquidity, that's one area that some funds have asked us whether creating a structure where you can lock up liquidity and get a fee discount. We are open to all sorts of structures and fee discounts. It's a matter of balancing. We shouldn't be locking up a capital for way too long for a small discount in fees. That really wouldn't be a discount if you think in terms of the trade-off. Next question is, I'm going to jump into, the last topic in terms of coverage, but the most important, Tim went over our process in how we vet managers and what's our system for conducting due diligence. At the end of that, we always have a rating system. Most of you are aware of, what our rating was before. We modified the rating system starting this year. From your perspective, in terms of process, it doesn't really change much, but this is more on our side where it gives more clarity in terms of what our view is and where we stand on each product. So it is just a question of moving from something that is more qualitatively named rating scheme to a numeric rating. So if you look at the two boxes on the left that which says the current rating system, which is now the old rating system, we had three categories basically that amounted to a preferred rating. One was preferred, which is equivalent to number one in the new rating system. That's where it's unqualified. All our clients are able to invest in those. Preferred close is something that we underwrote, but the fund is closed and we can't allocate more. Preferred conditional was something where a fund where we had high conviction in, but for various reasons, it would not be a product that all clients would be able to invest in. So those were the three main categories on the preferred side. We had two neutrals. One was basic neutral, where it's there's nothing glaringly wrong with it, but sometimes there's not a compelling investment thesis out there. And then a client neutral, which was basically where a fund was neutral more specifically in terms of how it fit in a particular client's portfolio. In the final two categories, one was not recommended, which was basically a fail, and the last was not rated. So the not rated category does not change at all for the two categories. Moving on to the newer rating system, we are going to have numerical rating from 1 to 5. 1 being our legacy preferred. So all our preferred funds that were under the old rating system will be grandfathered into the newer number 1 rating. Number 2 and onwards would be, differences in our views. So number 2 is a compelling strategy, but it's not technically, 100% a number 1 rating. Number 3 is, where there's not enough compelling, it's a satisfactory fund, but not a compelling thesis. Number 4 is, where we think the investment thesis may not be very clear. Some of the weaknesses might be outdoing the positives in the product, which would not make us comfortable enough to put it in number 3. And number 5 is basically it lacks any kind of compelling investment thesis and a fund that would not be recommended by us to our clients. So it's, from your standpoint, again, I repeat, it's not any big change or any change at all in how you deal with us. This will be on our side and how we view and we rate products. So I think this just reiterates everything I've said before, this slide. Finally, I think one thing that we are going to start doing more is on the alternative side, we are going to implement or start implementing a netting and vetting process similar to the one that we have on our traditional vetting process. That's kind of, looking at the peer group before, finalizing on one product, or kind of making sure we are aware of all the market players, the committee is aware, and then kind of go from there on into kind of funneling to the final product. So with that, I think that Tim would like to wrap up.
Great, thank you, Dulari. So just a couple final comments on how best to work with us. I mentioned our website. You can stay on top of our views there. We are trying to engage digitally with our clients and with our partners like the investment management community. I think we want to hear about good ideas. I hope you understand our perspective, that we have a lot of people calling us every day telling us that they're bringing us good ideas. And so the answer may be no, and that's where sometimes our relationship can be a little bit more adversarial. Please understand that we would love to meet with everyone, but in order for us to do the best research that we've got to focus on a smaller subset of ideas. And that can mean, especially for those of you at larger firms, that probably means just bringing us a few ideas as opposed to many ideas over the course. But we hope to continue to engage and partner with all of you in the investment manager community. We hope we can continue to deliver information about client needs and search activity, our views on the market and what we're saying to clients, how we evaluate managers. We should be getting back to you. No answer is not an answer, so please follow up with us, and we owe you that. When you think you have something that we should be meeting on, we should tell you whether we should be meeting on that or not. And we owe you candid feedback when strategies aren't that compelling to us or don't fit with what we're trying to do. We're going to try to do the best we can to be honest with you about that. So really appreciate everyone taking the time here to listen in on what's going on at NEPC and how we're looking to partner with the investment management community. We do have a few questions here. So just to kick it off, maybe for Tim, we talked about reducing U.S. equity exposure. How about structure within equities? Are we making any recommendations given growth has outperformed value for so long?
So I'm going to answer that question slightly differently and then come back to value growth. I think when we didn't include the implementation slide here, we've segmented the market, U.S., non-U.S., and global by tracking error. And so we've often done now in the U.S. is we have a preference for kind of passive, particularly in U.S. large cap, and then high tracking error. We've done a lot of work on should we be positive value over growth because of recent outperformance of growth, which is at the core of that question. We haven't quite been able to get there to make an explicit recommendation for value over growth. What we are doing, though, is for clients, and this is probably not uncommon, they look to kind of move on from an underperforming manager, which may have a value tilt compared to a growth tilt. And so when we run our active risk budgeting, which looks at alpha correlations, we do try to make sure that a manager or a client isn't just adding 2 or 3 more growth names to a portfolio because they've done well. And so we try to balance that with either something core, something quality, or something value when we do portfolio construction. So we're not quite there to say value over growth, but we're very cognizant of recent outperformance of growth.
A quick one here that I'll take, looking for our thoughts on infrastructure. We did bring through, towards the end of last year, a private markets focused infrastructure strategy. I would say that's where more of our focus is, on the private side. We have analyzed and evaluated listed infrastructure and have found that to just be more of a pure equity market play. Haven't really seen the differentiation in performance relative to the broader equity market. So we are looking at infrastructure strategies. Certainly it's something with some potential tailwinds in the U.S. Everyone kind of agrees that we need better infrastructure, but haven't seen anything get done from a government level. So evaluating, but just one strategy that we've brought through so far. question that I think, Dulari, you're perfect to answer given your role as co-chair of our impact committee. Looking for a little bit more perspective on NEPC's approach to ESG and how we evaluate its importance in the investment process.
So our group, NEPC group, Impact Investing Group, we have about 20 members in that group, all coming from different aspects of the firm. We have 10 folks from different practice group and 10 members from the research side. Specifically on ESG and our views on it, I think that has been an increasing area again within the industry, and to that effect, we have actually built a ESG scorecard or a rating sheet that we will start implementing and looking at funds and scoring them, and that would be a parallel process to our due diligence process on the preferred or number one rating category. So they're completely independent. But specifically on ESG side, we are looking to see how integrated is ESG factors into your research process. What is the thought process in including those factors, and how material are they in your decision-making process? And finally, there are, reporting mechanisms included in the product which capture everything. So, I think that's a space that we are spending more time on, and we will be starting the work on rating all our products using the ESG scorecard internally.
Great. Thanks, Dulari. Maybe time for just one more question. And I think, Tim, you'd be great to answer this one. NEPC has been out there talking about beta groups as a way to think about portfolio construction. You went through our coverage model, very, very much still more asset class focused. Can you talk about how beta groups apply to our manager research coverage?
So I think it's a good question. So I'm one of the co-heads of our equity group. Dulari co-heads our credit group. Actually heads our credit group now. So one of the things that we looked at, and if we look at client portfolios going back 3 years, oftentimes we would be very siloed. So there might be a theme that we liked, let's say emerging markets, and we'd have it in GAA, we'd have it in equity, we'd have it in credit, we'd have it in hedge funds. And when you aggregate it together, you have a very big overweight to emerging markets. And so a couple of years ago, just thinking about it from an equity credit kind of multi-asset landscape, there's really that spectrum of equity. So a long-short equity strategy is very similar to a long-only strategy, just more unconstrained. And we really should be thinking of it on that continuum all the way through private equity. It really starts with passive, and then you kind of work your way through the various forms of active. And so a couple of years ago, we started meeting, and now we're meeting even more frequently and delivering our views to clients kind of across these groups. So if I have a positive view, let's say on high tracking error U.S. equities, that might take the form of a flex equity concentrated strategy, pairing it with a passive to reduce overall tracking error, or it might be a long-short equity strategy that's high net, that can accomplish some of those same goals, and really thinking of it as equity risk is equity risk is equity risk. So we should be thinking about that across the spectrum. And so that's something that internally we discuss more. We're starting to build portfolios using that landscape, and I think it helps on that continuum. So hopefully that kind of gives a little bit of a background on it.
Great. Yeah, that's helpful. So why don't we wrap up there? Really appreciate everyone taking the time to sit in and listen to what's going on at NEPC. Feel free to reach out to folks in research if you have follow-up questions. And as I mentioned before, we will be posting this WebEx to our website, so you can feel free to dive into it further there or pass on to colleagues who may not have been able to make it. So thanks very much. Have a great day.